AI is not going to kill your agency, but it may kill your retainer, and here's why. If your agency used to spend 40 hours delivering client work and AI cuts that down to 15, you may think, great, our margin just went up. But your client may think, great, why am I still paying the same fee? That is the pricing trap agency owners need to fix now. AI does not just change delivery, it changes the pricing conversation. And if your agency is still selling hours in disguise, your margins are exposed. AI creates capacity, not profit. I'm Craig Cody, I'm a CPA, and we work with marketing and PR agency owners to help improve profitability, cash flow, and tax efficiency through proactive tax planning. And today I want to talk about a recent episode of the Two Bobs podcast with David C. Baker and Blair Enns called Is AI Going to Kill Labor-Based Pricing? Because that conversation hit on something every agency owner needs to hear. Procurement is not going to protect your margins. You have to. And what they discussed lines up perfectly with what we preach to agency owners every day. If you do not know your numbers, you can't protect your margins. And if your pricing is still tied to hours, AI may expose that weakness faster than anything else. Towards the end of this video, I'll give you the number I would look at first to see whether AI is actually improving your agency profitability or just helping you do unprofitable work faster. AI is not a pricing strategy. Let's start with the big issue. AI is not your pricing strategy, it's a tool. And tools only improve profit if the business model is built to capture that profit. If your team used to spend 40 hours producing a strategy, a campaign, content plan, a media report, or some other PR deliverable, and now AI helps them produce that same work in 20 hours, that could be a major win. But only if your pricing model allows the agency to keep some of that efficiency. If you charge by the hour, or your retainer is really just a fixed bucket of hours, then faster delivery can create pressure because the client may start thinking, if this takes less time, why should I pay the same fee? That's where agency profit gets squeezed. In the Two Bobs episodes, Blair Enns made the point that procurement departments may say they want to move away from hourly rates, but many still cling to labor-based pricing. Hourly rates and full-time employee pricing, and from their side, that makes sense. Procurement wants to buy your efficiency. They want AI to lower their costs. But as the agency owner, you need to ask a different question. Does every productivity gain belong to the client, or does some of that gain belong to the agency? Because if you carry the payroll, you invest in the tools, you train a team, you take the risk, then your agency should participate in the upside. That is not about overcharging. That is about pricing based on value, not just effort. Faster delivery does not automatically mean better margins. Stop selling hours in disguise. Here's the second problem. A lot of agencies say they do not bill hourly anymore. But when you look closer, they still sell hours in disguise. The retainer says strategy support, but internally it's based on 40 hours. The proposal says creative services, but the price was built from estimated time. The client buys a monthly program, but the agency manages it like a time bind. That is still labor-based pricing. And AI makes that model fragile because if the client bought hours, they will eventually want the savings. A better move is to shift the conversation from inputs to outputs. Inputs are hours, outputs are deliverables. Value is the business problem you solve. So instead of selling 10 hours of strategy, you sell a 90-day positioning and messaging sprint. Instead of selling 20 hours of design, you sell a launch-ready campaign package. Instead of selling monthly marketing support, you sell a defined growth program with clear deliverables, reporting, and decision points. That change matters because now you can manage the work like a business. You can ask, what does this package sell for? What does it cost to deliver? Who touches the work? How long does it actually take? What is the gross margin? And what happens if AI reduces the delivery time by 30%? That's the agency owner conversation, not how many hours did we bill, but how much value did we create? How much profit did we keep? Your retainer may be a margin trap. Now let's talk about retainers. Most agency owners want more recurring revenue. And that makes sense. Recurring revenue can stabilize cash flow. It can make hiring easier. It can make forecasting more predictable, but recurring revenue is only helpful if it's profitable recurring revenue. A bad retainer does not become good just because it repeats every month. If your retainer is just a discounted bucket of hours, AI will create a problem because the client will eventually ask, why are we paying for the same amount of time if the work takes less time? And that is why the retainer needs to be built around outcomes, deliverables, access improvements, or ongoing business value. For example, a PR visibility program, a content engine, a quarterly campaign, an optimization program, a paid media strategy and reporting program, a website conversion improvement program, a strategic advisory relationship. The point is not just to collect the same amount of money every month. The point is to create a model where the client understands the value and you understand the economic. That means you need to know the margin on that retainer. You need to know whether the client is being overserviced. You need to know whether the team is burning time on low value work. And you need to know whether AI is improving profitability or just helping you do more unprofitable work faster. Let me ask you this, and comment below with one word: hourly, retainer, project, or value. Which pricing model does your agency still rely on the most? And if you're not sure, that may be the first sign that your pricing model needs a closer look. Know your AGI, or agency gross income. Now let's connect this to the financial side. At Craig Cody & Company, one of the numbers we want agency owners to understand is AGI, because top-line revenue can be very misleading. If your agency bills a client $100,000, but $70,000 is media, production, freelancers, or some other pass-through costs, you do not have $100,000 to run the agency. You have the amount left after those direct costs, which is $30,000. That is the money available to pay your team, your overhead, your taxes, and your profit. Revenue is not the number that tells the full story. Margin does, cash flow does, and profit does. Remember, revenue is vanity, margin is reality. And this becomes even more important as AI changes delivery, because if you're looking only at revenue, you may think the agency is doing better than it really is. Remember, revenue does not pay the bills. Margin pays the bills. Cash flow pays the bills. Profit keeps the business healthy. So when you introduce AI into your agency, do not ask, are we getting work done faster? Is our agency gross income improving? Are our people costs becoming more efficient? Are our margins expanding? Are we still pricing based on old delivery assumptions? Are we tracking profitability by client, by service line, or package? And that's where the real opportunity is. AI should not just make the team busier, it should make the business healthier. And this is the real number. I mentioned this earlier. If I wanted to know whether AI was actually improving your agency, I would not start with how many hours you saved. I would start with your margin. Specifically, agency gross income by client, by service line, or package, because that tells whether AI is improving profit or simply speeding up work that was never priced correctly in the first place. Monthly numbers protect profit. This is where the monthly financial review matters. You cannot run an agency by checking the books once a year. You cannot wait until tax time to find out whether your pricing worked. By then, the year is already over. Agency owners should be reviewing their numbers every month. Your profit and loss, your balance sheet, your accounts receivable, your accounts payable, your cash flow, your gross margin, your people costs, your overhead, your client profitability. Because AI can make bad numbers look better for a while. It can hide over-servicing. It can hide bad pricing. It can hide poor utilization. It can make the team faster without making the agency more profitable, and that's dangerous. Faster is not the goal. More profitable is the goal. And if you manage your agency on an accrual basis but file taxes on a cash basis, you need to understand the difference, because your accrual profit and your taxable cash income may not be the same number, and that can create surprises. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.